Good morning, guys. It's no surprise. The Fed met last week, and there's one thing about mortgage rates that almost everybody gets wrong, including a lot of people in my own industry. So today, on this episode of the Monday Mortgage Minute, we're going to clear things up. And by the end of this, you'll have a clear understanding of what sets your interest rate. We're going to recap what happened at the Fed meeting last week. We'll give you some predictions what's happening with markets this week, and then look at a long-term picture. So let's not waste any time. Let's dive right into this. Starting with last week, the Federal Reserve met, and they left interest rates where they were. The point we need to really focus on, and only a few media outlets caught this, is there were 3 members. That's 33% of the total number of members on the board that wanted to raise interest rates. This is highly unusual to have so many folks dissenting. This is perhaps the largest number that we've seen in many, many years as far as it goes to voting and dissent. And their next meeting is in September. Now, what most people hear is that the Fed news is good and they assume it tells them where their mortgage rates are headed. Here's the thing, guys, it doesn't work this way, and this is the part that's really worth understanding, or it's going to cost you perhaps hundreds of thousands of dollars over a 30-year period, and in the near term, a couple $100s a month. The Fed sets one specific rate. It's what banks charge each other to borrow money overnight. This is all very short term, and obviously a 30-year fixed mortgage is not short term. These are totally different animals. So the Fed can hold steady or even cut interest rates, and your mortgage rate can move the other direction that same week. That's not a glitch. These are set by 2 different modalities, and they're 2 different rates that answer 2 different things. So what does actually move your mortgage rate? That's the bond market, specifically the 10-year Treasury bond. When investors worry about inflation, they ask for higher returns to lend their money. Those rates, So what does move your mortgage rate? It's very easy. The bond market, specifically the 10-year Treasury bond. When investors worry about inflation, they ask for a higher return to lend money. Those yields rise. The mortgage rates rise up alongside of them. Right now, the 10-year is at 4.68%. We opened at 4.72%. To give you some perspective, the end of February, we were at 3.99, and on this day last year, the markets opened at 4.28. That is the top of where it's been in over a year and a half. That's not a Fed headline. That's the actual number that we need to be watching. So now let's explain and understand how this math works when it applies to your budget when you're purchasing or refinancing a home. 2 things drive your monthly payment. Really simple. The rate and the price of the home. How much each one moves the number is pretty easy as well. So on a $400,000 loan, every 0.5% of interest is roughly $134 per month. And every $20,000 price increase is about the same. These are rounded example numbers, so these are not exact quotes, but I want you to see these levers, and when either one moves, your payment moves with it. Now just imagine in September, if a home's appreciated $25,000 while you were waiting, and your interest rate, the base rate, has gone up 0.5%, that's $134 on top of $130. You're paying an extra $264 a month because you decided that waiting was your strategy. That's just how this machine works. There's no getting around it. So with the Mortgage Bankers Association and a few other folks telling us that rates could be this high or higher through the end of 2026, the end of 2027, and maybe into 2028, should we really be waiting if you need to get into a home? Here's what I take away from all this. Don't let a Fed headline make your decision in either direction. That number that matters is the bond market, not the federal overnight rate. And the math that matters is your rate, your price, and your zip code. There's one other small piece of that. That's what product you're using. But these are what national averages cannot tell you. If you ever want to see what these numbers actually look like, talk to people. Talk to your mortgage loan advisor. Hit me up. Book an appointment. Let's get on a Zoom call, on a phone call, text message, whatever you want to do. Talk to somebody you trust. There should be no pressure either way. But if you know how this really works, that was the whole point of this. I'm Paul Messina. I go by the Mortgage Vet Paul on social media. I'm with Milestone Mortgage Solutions, VA loan specialist and mortgage advisor. Thanks for your time, guys. Pass this along, like, subscribe, and we'll see you next week.